Have you ever wondered why buying a house feels so much harder than it did for your parents? You're not just imagining it, the rules of the game have changed, and a big part of the story starts on Wall Street. Today, we're diving deep into how financial giants transformed the American housing market and what it means for you. Before 2008, the path to homeownership was relatively straightforward. You'd save up, get a loan from a local bank, and buy a house. Banks held onto these loans, so they were careful about who they lent to. But then, Wall Street had a brilliant and ultimately catastrophic idea: mortgage-backed securities. Imagine a mortgage as a simple IOU. Now, picture Wall Street taking thousands of these IOUs, bundling them together into a giant financial product, and selling slices of it to investors all over the world. This was the mortgage-backed security, or MBS. Suddenly, the local bank didn't have to worry about whether you'd pay back your loan over 30 years. They could just sell your mortgage to Wall Street, get their money back instantly, and then go find someone else to lend to. This created a massive incentive to issue as many mortgages as possible, as quickly as possible. Lending standards plummeted. No job, no income, no problem. These were the infamous ninja loans: no income, no job or assets. The demand for mortgages to feed the Wall Street machine seemed endless. It was a classic gold rush, but instead of gold, they were mining mortgages. This frenzy drove housing prices through the roof. Homes became speculative assets, not just places to live. Everyone thought the party would never end. Then, in 2008, the music stopped. As interest rates on those risky loans reset, homeowners started defaulting in record numbers. Those mortgage-backed securities, once considered safe as houses, were suddenly revealed to be filled with toxic debt. The value of these assets collapsed, triggering a chain reaction that brought down major financial institutions like Lehman Brothers and pushed the global economy to the brink. The housing bubble had burst, and millions of Americans lost their homes in the ensuing foreclosure crisis. In the aftermath of the crash, you might think Wall Street would have backed away from housing. But they did the exact opposite. As foreclosures flooded the market, a new opportunity emerged. Private equity firms and large institutional investors, armed with billions in capital, saw a bargain. They started buying up thousands of foreclosed single-family homes, not to flip them, but to rent them out. Think about that for a second. The very firms that had, in many ways, fueled the crisis were now swooping in to buy up the wreckage at rock-bottom prices. They transformed from financiers into the nation's largest landlords. Companies like Blackstone, through its subsidiary Invitation Homes and American Homes for Rent, became household names, not for building homes, but for buying them. This wasn't just a few houses here and there. We're talking about entire neighborhoods. In cities like Atlanta, Phoenix, and Charlotte, these corporate landlords acquired a significant chunk of the available single-family housing stock. For the first time in American history, large corporations were competing directly with regular families trying to buy their first home. So, how does this new reality affect you? First, competition. When you make an offer on a house, you might not just be bidding against another family. You could be bidding against a multi-billion-dollar corporation that can pay in all cash, waive inspections, and close in a week. It's an incredibly difficult scenario for the average beer to win. This intense competition from deep-pocketed investors directly drives up home prices for everyone. Second, it reduces the supply of starter homes. These corporate landlords specifically target the same modest, 3-bedroom, 2-bath houses that are perfect for first-time home buyers. By converting these homes into permanent rental properties, they take them off the for-sale market, often for good. This shrinks the pool of available homes, creating a bottleneck for an entire generation trying to build wealth through homeownership. Third, it changes the nature of renting. If you're renting from one of these large corporate landlords, your experience is very different from renting from a local mom-and-pop owner. These companies are driven by shareholder returns. This can translate to aggressive rent hikes, an array of fees for everything from paying rent online to late trash can removal, and a more impersonal, automated approach to maintenance and tenant relations. The goal is to maximize profit from the asset, and the asset is your home. This has created a feedback loop. As more homes are bought by investors, fewer are available for purchase, which drives up prices. Higher prices make it harder for people to buy, forcing more people to rent. Increased demand for rentals allows corporate landlords to charge higher rents, making their business model even more profitable, which encourages them to buy even more homes. You can see how this cycle perpetuates itself, locking many people out of homeownership. Now, some argue that these companies provide a valuable service. They offer professionally managed rental housing and brought stability to markets that were devastated by foreclosures. They invested capital when no one else would, renovating homes and creating a new asset class for investors. And that's not entirely wrong, but it's crucial to look at the broader consequences. The shift from owner-occupied homes to corporate-owned rentals fundamentally alters the fabric of communities. It concentrates wealth and property in the hands of a few large entities, while making it harder for individuals to build their own equity. Homeownership has historically been one of the most reliable paths to middle-class wealth in America. When that path becomes a dead end for millions, it has profound implications for economic inequality. So, what happens next? The trend isn't slowing down. Wall Street is still innovating, creating new financial products tied to single-family rentals. The build-to-rent model is also booming, where entire subdivisions are built from the ground up with the sole purpose of being rental communities owned by a single corporation. This isn't a simple story of good versus evil. It's a story about incentives, financial innovation, and the unintended consequences that ripple through society. The housing market is no longer just about shelter. It's a key component of the global financial system. And when your home becomes just another line item on a Wall Street balance sheet, the rules of the game change for everyone. Understanding this shift is the first step in figuring out how we can build a housing market that works for people, not just for portfolios. Thanks for watching. If you found this breakdown helpful, be sure to like this video and subscribe for more deep dives into the forces shaping our world. Let us know your thoughts and experiences in the comments below. See you next time.